Day 3, trying to get the perfect thumbnail. Action. Oh shit, that's the... All right, so that played out a lot different than I expected, but Chad, I hope you had a wonderful day. We have a lot to talk about. We had another day post CPI. I mean, the reaction was pretty weird. We pretty much didn't do anything. The PPI data didn't move us around, but what I want to talk about on today's video is the debt ceiling. Now, I brought this up a couple weeks ago. We mentioned it at the beginning of the week, but the talks are intensifying, and I have a very easy way for you to understand it. And lastly, I hope you understand the full scope of all of it. So that's what I want to run down, because everybody's saying it's going to crash and everybody's saying the debt ceiling is a problem. And then, of course, you hear the obvious, it's not going to be a problem. First, maybe that's where we should start, honestly. First thing is first. This is where every single debt ceiling discussion must begin. First thing first. It's not going to happen. It never has happened. The U.S. will never default. There has always been a last-minute deal, and we are not a deadbeat. No, we're not a deadbeat. So that's the first, every conversation, whether you believe it or not, whether you're government or not, this is where every part of the conversation must start. The fact of the matter, the one time that we freaked out, it wasn't even a debt default. It was a debt downgrade, but this is where everything is starting. So why I'm making this video today, why we're even talking about it, we've got that out the way. It's a low probability event. It shouldn't happen, right? Well, here's the thing. We were talking about it last week. We see where we're at today, but the problem is the actual probability now today is 3%. It is very tiny, it is small, but now there exists some possibility of the default. It is now standing at 3%. If you look at the credit default swaps, that is also hitting an all-time high, and people are bringing this up. So I'm not going to get into the details about it because we need to make this very simple. The probability is low, so there you go, but at the same time, the picture as a whole, it means something and it doesn't. And what it means is that, yeah, it probably won't happen, but what you are starting to see is people are hedging for the event. So the simplicity of all of this is simple. The minute people start hedging, that is the moment that the possibility actually becomes real, and then it's kind of a domino effect, because as we move forward, if people are saying, no, this isn't a big deal, but they start to hedge, by hedging, you start to acknowledge the possibility that the risk is either apparent or near, and pretty much all the way up until the X date, June 1st, if you start seeing people continue to hedge for this event based on the lack of resolution, even though it's playing out as it always played out, that is where we are starting to get this reaction in the market. So hopefully you're following along right now and understanding everything that we're saying. Everybody's talking about it. History says it's a low probability. Even actually right now, the probability is technically low. You have certain things like default swaps in America showing risk, and day after day, you're watching some people react and some people aren't. The thing I brought up to you was this bond chart. We talked about, look at the 3-month and the 1-month and that kink in the bond curve, right? This is another one of those examples showing evidence of people responding and hedging to the possible risk. So even though it's a small probability, people now have begun, as we are about 2 or 3 weeks ahead of the date. So hopefully you're getting this all at a whole. I'm hoping that you're understanding the basic nature of the debt ceiling, but this is where we're at now. And now, this is even where it gets better. Here's a chart. Shout out to ZH, baby. If you know, you know. But this is comparing the S&P 500 right now to how it looked in 2011. So there's a couple of things we need to clear up. Again, going back to history, 2011 was not a debt default. It was simply a debt downgrade. The United States got their credit downgraded, and the head of the S&P at the time, he was even forced to resign. You're not going to watch that happen again. It was a big deal 10, 12 years ago. You're not going to get a downgrade before the credit event this time around. So the only risk here is the actual default. But take a look. The markets look very, very similar. And this is now where people are starting to freak out. And I want you to notice 1 week before. If you kind of see when the market dropped, look at the week prior to that. And we're going to get into that towards the end here. But the other parts I want you to notice here is where it says extreme measures. Now, that looks like it happened in 2011 in May. And guess what? For you right now in this scenario, that's not new. You got the announcement of extreme measures in January 2023. So almost 6 months ago, 5.5 months ago, pretty much at this point, that is when Yellen said, we are going to be doing extraordinary measures. And she came out 2 weeks ago saying that we're going to run out of money by June 1st, and that is when we exhaust all of it. So there might be a little bit of confusion on this chart and comparing it to 2011, but regardless of what happened in 2011, the point I'm trying to say is that we really started this discussion 5-6 months ago. The reason why people are starting to hedge, the reason why you're hearing about it a lot more is because now we are 2.5 weeks away or so. And that is the whole point with all of it. So this is what leads us now to the final point and the final theory. We talked about this today. I heard people bring this up and I was very surprised, but it makes a lot of sense. And it even falls into the political narrative of all of it. But essentially, like we said, watch as people hedge as we get closer to the X date. But what some people are starting to say is that if 1 week before the event, if we still do not have this situation resolved, the markets will begin to panic. So keep this in mind because this is what we're looking out for. And essentially, what are we worried about? The worry is a default. The when is pretty much the when to react. It's a week before the X date, the June 1st that was listed. So why? And there's a couple of reasons. One, people believe that's when other market participants will start to hedge. But now also two, once the markets start responding, that is how you get Congress to start moving. This is what we even brought up on the other video, and we brought it up a couple of times, but essentially, until the markets start responding, people will not take the risk as serious. So if a week before the event nothing's resolved, some people are assuming the markets will start to panic. People will hedge. As people start watching the hedges go up, people will react to people getting hedges, and then it'll set this off, and then markets will start moving, and then hopefully that market movement will force Congress into action, just like a downgrade did in 2011. So that's the interesting part about all of it, and that's where we are now. But I hope you are getting the full story. This has been going on for 6 months. We are now 2 weeks away from the event. The worry is a default, not a downgrade. It's never happened before, and in 2011, the only time it did happen, it was a debt downgrade and not a debt default. And the final question, what happens? You've heard people in Congress say it. You've heard Janet Yellen, and they said it would be catastrophic, apocalyptic. They said it was just something they don't want to think about. And all of those people are correct. No matter what, the event is negative for everybody, Republican or Democrat. Even if it leaves a stain on Biden's record, it is going to hurt Republicans. Even if the Republicans get hurt in the event of a debt default, it would hurt the Democrats. It doesn't matter politically, and 2011 is the example, because right when the market started getting affected, everybody's constituents on both sides, they all started to respond. So everybody would get affected and every asset in the world would go down. This isn't just political. It would bring everything down. The play is simple. Ironically, people say you still buy bonds, even though the bonds would default. I'm not going to talk about that, though. But the point is, it would be a disastrous effect for everybody, both political connotations to it, all the way down to the economic effect of it. it would be bad. It would affect credit, and it would leave a stain on the credit of the United States forever, just like the downgrade did in 2011. It wasn't even a debt default, but the downgrading of U.S. credit from 2011, it has remained there since 2011. It has not came back. Once there is a blemish on credit, there is no going back, my friends. So it would have a very negative effect. People have still been asking, what play do you do, all that, and that's why I've been saying here, it's really just, it's going to be an easy short, but it's not like, it really even goes beyond the play, and that's why people are assuming that a deal will be resolved, because it is a very avoidable event. Pretty much what I said today on stream, if the government, Fed officials, and all these people went to such extreme effort to prevent, risk on or risk and crashes in the market, to prevent banks from failing, what makes you think that they are going to just go asleep at the wheel and try less harder to get a bigger crash and do less than something that is just way easier to manage than a bank crash? Pretty much, if they don't figure this out, this will be bigger than all of the banks getting clapped, and then they could solve the debt ceiling situation easier than they could solve even one SVB. So that's the irony with all of this when it's all said and done, and we're going to see. But hopefully you're seeing what we're talking about, and this is why the probability is low too, because it's a disastrous event. So I hope this keeps you up to speed. 1 week before is your date. This video is very informational. Do not forget this, because we're probably going to talk about it then, but I hope you're prepared in advance, and let's see what everybody does. But that's it for everything. Again, the PPI data today, it showed hopes that maybe the data before the Fed might be better, but otherwise no new developments. Tesla announced a new CEO, or excuse me, Elon announced the new CEO for Twitter, so that was good. Again, you had a lot of these movements, but a lot more debt ceiling discussion. We have consumer sentiment tomorrow. The pause odds are interesting. And now this is the thing. I made this play. I might make this bigger. I did this last year around the same time these debates started coming up. I think I did it a little later, but I shorted the Fed futures, so the Zaza/ZQM23. I shorted the June futures. Again, it's saying the probability is 99% of a rate pause. So pretty much it's like your upside is limited on a short. And if the market freaks out, I only see upside. So I like the risk to reward. I feel like it's too easy of a trade and I'm missing something, so it's definitely not a recommendation. We're going to see. That's why I only went with one, but for the most part, that's one trade I like. And then we flipped oil today. There was news about refilling the SPR right when we run out of money on June 1st, so that's great. But Chad, I'm going to leave it there. I'll see you tomorrow. We'll close out the week, see how it all is. The earnings are wrapping up, but then before you know it, the narrative will reveal itself, but also maybe get ready to chill within this range. And, remember, sell it may go away, but that is your watch list, ladies and gentlemen. Make sure hydrate, healthy, ready to go. Make sure you post our watch list. Make sure we see you there in the morning. I need the armor on. I need the helmet shining. I need you to remember, man, life is more than anything with the dollar sign. But even then, I hope I'm a person and you're a person. And I just, as people, we share some of the same life experiences. And I just go listen to the philo, bro. So just keep that in mind at every corner. I hope you know what's important. I hope you focus on all aspects so you're well balanced and stay in the game and get some strength and some peace. And you got people around. That's good. We good. That's it. I'm out. I'm not even going to make it awkward. You see SDSU? I wore this to you, right? I wore this for the NCAA. I was wearing it today. It's a soft sweater, man. Y'all got college merch? Let me get some college. This is soft. They did good back in my day. Okay. It wasn't awkward, but I was about to start ranting like an old man horn.